How's it going, investors? I'm Ari and welcome to my channel. Now, if you are brand new here and just stopping by for your first time, this channel is all about value investing as well as dividend investing, where my sole mission is to help you achieve whatever financial goal you have in mind. Now, with that said, I started this channel back in 2019 with the goal of hitting $100,000, to which I did not too long ago. My account is currently sitting at $101,051.24. So from here on out, I'm literally just going to be providing you with market updates, share about discounted dividend stock opportunities, and keep you all updated with my personal investment moves. So as for today's video, we are going to be doing just that, covering a macro level overview of the market before going over 5 dividend stocks that are currently trading at steep discounts. But not only that, analysts and hedge funds are betting big on each of them, which if they're interesting to you, then may be worth the add to your stock watch list. And before we dive in, all I ask is that you go ahead and tap on that thumbs up button, and of course, join me on the journey by subscribing. Now, investors, let's go ahead and get right to it. At this point in time, I'm sure you're well aware that a red-hot inflationary reading came in above the expected 8% inflation reading, which inflation is now hovering around 8.3%. And of course, that's better than 8.5%, which it was about a month ago, but it still remains sky high. Now, the inflationary news spooked the market last week, and we had one heck of a sell-off, with all major indexes experiencing the worst decline since June. As we speak, the calm is not yet over, with eyes and ears on the Federal Reserve this week as we're awaiting their chess move against inflation. Now, why exactly did this inflationary report sound the market alarms? Well, high inflation means higher interest rates, which is expected this week from the Federal Reserve, that they're likely to now bump the interest rates by 75 basis points as opposed to 50. This will hinder growth for businesses, and there you have it, a market that is at odds, in fear, and without certainty, which is creating all of this market volatility. However, it's that market volatility that is really just opportunity for long-term value investors, which, by way of you watching this video or any of my other videos, leads me to believe that you are that long-term value investor. So let's go ahead and break down this first dividend stock, which is BlackRock, ticker symbol BLK. It was initially founded as a risk asset management firm in 1980 by the one and only Larry Fink. Now, since BlackRock's founding, it has expanded operations to become one of the world's largest asset management firms, with over $10 trillion in assets under management, now providing clients with investment and advisory services as well, which has resulted in their market capitalization amassing to $97.5 billion. However, I wouldn't be bringing this to your attention if we weren't talking about a deal on the table for us all to enjoy. So BlackRock is currently down on the year by a little over 27%, trading for $644 per share, whereas it was once trading for almost $900 per share. Now, while such a decline may trouble some of you as a newer investor, you have to keep in mind that BlackRock generates revenue from fees. Now, generally speaking, it's going to generate more money when clients are throwing more money into the market for BlackRock to invest. And in the first half of 2022, BlackRock saw clients playing it much safer, with $10 trillion worth of assets under management drop to roughly $9.6 billion, which spooked investors like you and I right out of the position, and now creating this opportunity for us all, because let's face it, the stock market will essentially go back up in due time. Now, BlackRock's clients will once again be investing when it does. And if you really want to see something to boost your confidence in this particular opportunity, we could take a look at what hedge funds are currently doing, which shouldn't be a surprise to any of you that they are buying. And now, one particular buy that stands out to me is that nearly $500 million investment from the Saudi royal family, followed by a $122 million investment by Fisher Asset Management. As for where analysts currently stand, we can see that there's a lot of optimism, with a forecast coming in at $712.75 per share. That's about 10% worth of upside. Now, BlackRock currently has a PE ratio coming in at 17, which is not exactly below competitors, but I do believe that BlackRock just may be worth that premium. And as a shareholder of the largest asset management firm, BlackRock will surely reward you for it, with a dividend coming in at a dividend yield of 2.59%. Next up, we have what used to be a subsidiary of Kodak, for those of you old enough to remember, but what is now today a standalone and standout chemical company. We're talking about Eastman Chemical, ticker symbol EMN, which produces a broad range of advanced materials, chemicals, and fibers for everyday products, from makeups to plastic reusable water bottles. As of today, this industry leader has a market capitalization of just over $10 billion, but it's certainly been impacted by economic conditions, largely supply chain and customer production related, which has hindered Eastman Chemical's earnings, and therefore investors have backed away from the investment, causing its share price to fall from $124 per share at the start of the year to roughly $82 per share. Now, that's nearly a 30% decline in share price. However, with a PE ratio hovering around 8.9 and analysts expecting growth coming back up to a share price of $100.55 per share, which is a little over 21% worth of upside, I definitely think Eastman Chemical is a sound stock to add to your watch list. Not to mention, you would be joining Ray Dalio and other hedge fund managers in investing millions of dollars into Eastman Chemical should you actually proceed with investing into the company. But to sweeten the deal, of course, Eastman also pays out a nice dividend, coming in at a dividend yield of 3.53%. Coming up on our third dividend stock for the day, I want to talk about Capital One, ticker symbol COF, which is not only a bank that I utilize for their high yield savings account, as well as multiple credit cards, which if you are actually in need of a credit card, I have all those links down in the description below. But you may actually want to become a shareholder of this bank because Capital One, very similarly to many industry leading banks, has taken a major toll over the last few years from interest rates having been next to near zero, which is why it struggled and remains in limbo, with the share price coming in at $102.70 per share. That's down 30% from $160 per share where it started the year. And with a PE ratio coming in at just 4.4, it certainly may be a solid time to think about adding a bank like Capital One to your portfolio, especially as interest rates will only continue to rise from here, and banks will be major beneficiaries of these interest rate hikes, which is why we see hedge funds favoring the bank and investing into it, like Ray Dalio's Bridgewater Associates, or an investment from Penenza Investment Management or Fisher Asset Management adding over $800 million to their position with Capital One. But the one investment here that catches my eye is from Dodge & Cox. It's over $3.6 billion worth of skin in the game when it comes to Capital One. Of course, analysts are also optimistic when it comes to Capital One as well, with the target share price coming up to $146.27 per share. It's over 42% worth of upside, and until Capital One surges to those heights, shareholders are going to be able to collect on Capital One's dividend, coming in at 2.19% worth of a dividend yield. Now, remaining within the financial sector, our fourth dividend stock of the day is Synchrony Financial. That's ticker symbol SYF, which is a consumer financial services company that's focused on helping consumers and businesses with financing options, whether it's through savings products or credit lines. And while only founded more recently in 2003, Synchrony Financial has surely made an impact on the industry and has grown into quite a financial services company, with a market capitalization coming in at $15.29 billion. Yet similarly to Capital One, it's been impacted from low interest rates and inflation, which has slowed down consumers and businesses from spending ever so freely. So we can see here that their share price has fallen from roughly $48 per share at the start of the year to around $32.56 per share today, making for a 31.25% change, and an opportunity for investors given a low PE ratio coming in at 4.6, which has prompted hedge funds, of course, to swoop in, and we can see that Par Capital Management adding a massive sum to their position, bringing their value to over $220 million worth of this financial investment. As for analysts, they foresee almost 30% worth of upside potential here, with the share price coming back up to $42 per share. Now, of course, as we wait for that rebound in the share price, there is a nice 2.82% dividend yield that shareholders are going to be able to capitalize on. Finally, we have a leading manufacturer of home appliances, from your washer and dryer to your dishwasher and refrigerator. We're talking about Whirlpool, ticker symbol HWR, which has been in business since 1911 and has only continued to grow into a dominant industry-leading powerhouse when it comes to household appliances. Now, many of you may have been using their appliances as we speak, which leads me to the big question. If you're already using their appliances, why not invest right into the company, given you're trusting them enough to use those appliances daily? As of right now, Whirlpool has a market capitalization at $7.94 billion. However, given supply chain troubles as well as inflation keeping consumers away from making new purchases on newer appliances, and therefore Whirlpool's earnings didn't exactly come in so hot, ultimately leading to a share price decline. Whereas Whirlpool was once trading for $230 per share, but now trades for roughly $145 per share. Now that's 35% worth of a change, and honestly that makes quite an opportunity for the investor willing to remain patient with their PE ratio at 13.1, and analysts rating it as a buy for a longer term investor with a forecasted share price at $153.50 per share. But that's not all. To boost your confidence here some more, we can follow through on what smart money has been doing when it comes to Whirlpool, and once again we can see plenty of hedge funds investing into Whirlpool, like Kensico Capital with a $31 million investment, or Bridgewater Associates once again coming in with an $11 million stake in Whirlpool. Now, shareholders of Whirlpool would not only reap the benefits of their share price rebounding, but of course a dividend as well, with Whirlpool's dividend coming in higher than the average at 4.54% worth of a dividend yield. Investors, that's it for today. From BlackRock to Eastman Chemical and Capital One to Synchrony Financial and Whirlpool, the 5 dividend stocks that are not only trading at discounted share prices, but investments that hedge funds cannot get enough of and rated by top analysts as buys. Now, I'd love to get your personal take on any or all of these positions, if they're within your portfolio, if you're thinking about buying into them, or simply what you are currently focused on buying. Drop all those comments down below. Now, keep in mind that I'm not a financial advisor, so always do your due diligence following not only my videos, but any videos out there on YouTube or any information that you come across the web. And of course, just before we conclude, tap on that thumbs up button and help me grow this channel. If you haven't already joined me, go ahead and tap on that subscribe button as well. I'd love for each and every one of you to be on this journey with me. Now, investors, until the next video, I will see you all there.